Last week, I watched two people, let's call them Sarah and Mike, both earning $75,000 per year, both with the same credit card from the same bank, make completely different decisions about a simple pop-up that appeared on their phones. Sarah's screen lit up. "Update your annual income to help us serve you better." She thought for about 2 seconds, typed in her current salary, $75,000, hit submit, and felt good about it. Responsible, organized, being a good customer. Mike's phone showed the exact same pop-up. He stared at it for exactly 1 second, tapped the X in the corner, closed it without entering a single number, and went back to whatever he was doing. Same bank, same income, same credit card. Two completely different choices. 5 years later, Sarah has paid $11,600 in fees and extra interest that Mike completely avoided. Same income the entire time, same spending habits, same payment history. The only difference? Sarah kept updating that little income field every time the bank asked. Mike never did. That $11,600 difference? If Sarah had invested it instead of handing it to her bank, it would be worth $18,900 today. Over 30 years, that decision to keep updating her income will cost her $189,000 in wealth she'll never build. One pop-up, one decision, $189,000. As a dog, I don't understand why humans volunteer information that will be used against them. If another dog asks how many treats I have buried in the backyard, I'm not telling them where they are. That's basic survival instinct. But humans? You'll just hand over your financial data because a pop-up said, "Help us serve you better." Serve you better. That's what they said. Let me tell you exactly what that means. Today, I'm breaking down what actually happens when you update your income with your bank, how much it costs you, and why the smartest move is usually to close that pop-up and never look back. Let's start with something that's going to make you angry. When Sarah updated her income to $75,000, here's what happened behind the scenes that she never saw. Within 48 hours, the bank's algorithm recategorized her. She moved from moderate income standard customer to target for premium products. Her profile got flagged for aggressive marketing campaigns. Within 1 week, she started seeing ads for premium credit cards, cards with annual fees, cards she didn't need. The algorithm determined that someone earning $75,000 can afford a $450 annual fee, so those offers started flooding her inbox. Within 1 month, her credit limit got increased without her asking, went from $8,000 to $15,000. The bank didn't do this to be nice. They did it because higher limits lead to higher balances, and higher balances mean more interest payments. Within 6 months, she received her first personal loan offer, pre-approved for $25,000 at 11.9% interest. She didn't need a loan, but the offer sat in her email waiting for a moment of weakness, a home repair emergency, a why not decision. Let me show you the actual cost of all this targeting. Real numbers, real math. Premium credit card fees. Sarah eventually said yes to one of those premium cards because it offered 5% cash back on travel. The annual fee? $550. Her actual travel spending per year? About $2,000. So she got $100 in cash back and paid $550 for the privilege. Net cost? $450 per year. Higher credit limit equals higher balance. Before the limit increase, Sarah's average balance was $2,400 at 21% APR. After the increase to $15,000, her average balance drifted up to $4,800. Why? Because the limit created psychological permission to spend more. Extra interest on that additional $2,400 balance, $504 per year. Personal loan targeting. Sarah didn't take that first loan offer, or the second. But 2 years later, when her AC unit died and she needed $8,000 fast, she took the pre-approved personal loan instead of using her emergency fund, which she'd been slowly draining for other things. The loan was 11.9% for 4 years. She paid $2,120 in interest she could have avoided. Credit card upsells. The premium card came with exclusive offers for credit protection services, identity monitoring, and travel insurance packages. Sarah signed up for 2 of them. Cost: $216 per year for services she never used once. Added up: $450 plus $504 plus $530, loan interest per year averaged, plus $216 equals $1,700 per year in direct costs from being targeted as a $75,000 earner. But wait, as a dog, I know there's always more. Humans never see the full picture on the first look. Opportunity cost. That $1,700 per year, if Sarah had invested it in an S&P 500 index fund at 10% average returns, would grow to $277,000 over 30 years. She didn't just spend $1,700 per year. She gave up $277,000 in future wealth. Now let's talk about Mike. What happened when Mike closed that pop-up and never updated his income? Nothing. Absolutely nothing happened. His credit card kept working, his account stayed open, his credit score didn't change, the bank just didn't have fresh data to work with, so their algorithm left him alone. No premium card offers because the algorithm didn't know he could afford them. No credit limit increase because the bank didn't have updated income to justify it. No personal loan marketing because he wasn't flagged as a high-value target. No upsells because he wasn't in the premium customer database. Mike kept his simple, no annual fee cashback card. His credit limit stayed at $8,000, which was plenty for his actual spending. When his AC unit died, he used his emergency fund because he'd actually built one instead of getting psychologically nudged into higher spending by a higher credit limit. Same income, completely different financial outcome. The only variable? One of them kept feeding data to an algorithm designed to extract maximum profit. Here's what most people don't understand about banks. They're not asking for your income to verify anything. They're asking for your income to optimize against you. Let me explain how this works because it's genuinely fascinating in a dystopian way. Banks use something called ability to pay pricing. Sounds technical? It's not. It just means they charge you more when they know you can afford it. You'd think higher income means lower interest rates, right? Higher earners are lower risk. That's the logical assumption. But banks aren't optimizing for risk anymore. Modern algorithms are sophisticated enough to separate risk from price sensitivity. Here's the actual formula they use. I'm simplifying, but this is the core logic. If high income plus low price sensitivity equals charge more. If high income plus high price sensitivity equals charge standard rates. If low income plus high price sensitivity equals offer predatory products. How do they determine price sensitivity? They look at your behavior. Do you pay your bill in full every month? Do you carry a balance? Do you shop around for better rates? Have you ever called to negotiate? Someone earning $150,000 who's never called to negotiate their interest rate is a perfect target. The algorithm knows you can afford higher fees and you won't bother shopping around, so they charge you more, not because you're risky, because they can get away with it. Someone earning $45,000 who regularly transfers balances and shops for better rates gets standard pricing because the algorithm knows you'll leave if they overcharge you. This is why updating your income is dangerous. You're giving the algorithm another data point to optimize against you. Fresh income data resets the calculation. The algorithm wakes up and starts testing how much they can extract from you. The targeting cascade works like this. Day 1 to 7, income data enters the system. Your profile gets updated. You're assigned to a new marketing cohort based on income brackets, usually under $50,000, $50,000 to $75,000, $75,000 to $100,000, $100,000 to $150,000, $150,000 plus. Week 2 to 4. You start seeing targeted offers calibrated to your bracket. $75,000 earners see mid-tier premium cards. $150,000 earners see ultra premium cards with $695 annual fees. Month 2 to 3. If you don't respond to offers, the frequency increases. More emails, more notifications, more limited time urgency tactics. Month 4 to 6. Credit limit adjustments happen. The algorithm determines optimal credit exposure based on income. Higher earners get higher limits, not because they need them, but because higher limits correlate with higher balances and more interest revenue. Month 6 to 12. Cross-selling begins. Personal loans, home equity lines of credit, investment products, insurance packages. Every product pitched is algorithmically selected based on your income profile. Year 2 plus. You're locked into a pattern. The bank knows your income. They know your behavior. They know exactly how to extract maximum lifetime value from your relationship. And here's the truly insane part. Banks don't verify the income you report. Think about that for a second. They want this data badly enough to constantly ask for it, but they don't want it badly enough to actually verify it's accurate. They can't see your tax returns without permission. They can't access your pay stubs. They can't verify your employment. They're entirely relying on what you tell them. What does that tell you about how they're using it? They're not using it for risk assessment. They're using it for marketing segmentation and pricing optimization. If they were actually concerned about your ability to repay, they'd verify the number. They don't verify because accuracy doesn't matter for their real purpose. As a dog, this makes zero sense to me. Humans will voluntarily give data to an algorithm that uses it to charge them more money, and the algorithm doesn't even care if the data is accurate. It's like telling a squirrel exactly where you buried your food and expecting the squirrel to protect it for you. The squirrel doesn't want to protect it. The squirrel wants to take it. Let me be very clear about something because I don't want anyone getting in trouble based on what I'm saying. I am not telling you to lie. Lying about your income on a credit application is fraud. It's illegal. Don't do it. That's not what we're talking about. What I'm talking about is understanding the difference between required disclosure and voluntary updates. Here's when you actually have to provide income information. Mortgage applications, legally required. You'll provide pay stubs, tax returns, W-2s, employment verification, the whole thing. This is federal law under qualified mortgage rules. You cannot get around this, and you shouldn't try. Buying a house with no income verification is what caused the 2008 financial crisis. Nobody wants that again. New credit card applications, technically required for approval. The Card Act of 2009 requires card issuers to consider ability to pay. So when you're applying for a new card, you need to provide income. But here's the thing, they don't verify it, they just need a number in the field. Auto loans, usually required, but verification standards vary wildly. Some lenders do full documentation, others accept stated income with zero verification. And here's where it gets interesting. Here's when you do not have to provide income. Those pop-up requests on existing accounts, completely voluntary, 100% optional. There is zero legal requirement to update your income once you have an account. The bank wants it. They don't need it. You can close that pop-up forever and nothing bad will happen. Credit limit increase offers. If you want the increase, you might need to provide updated income. But if you don't want the increase, and most people don't actually need higher limits, you can just decline the whole thing. Phone calls asking to verify your information. These are sales calls disguised as account maintenance. You can hang up. You can say, "I'm not interested in updating that information." The call will end. Your account will remain open. Annual review requests. Some banks send emails asking you to confirm your information is current. These are not mandatory. They're designed to create a sense of obligation, but you can ignore them completely. Here's what Sarah didn't know. Every time she saw that "update your income" pop up, she assumed it was required. It wasn't. It was a request. She could have closed it. Nothing would have happened except the bank wouldn't have fresh data to use against her. Mike understood this instinctively. He never assumed a request was a requirement. When the bank asked for something, his first question was always, "Do I have to provide this, or are they just asking?" 90% of the time, they're just asking. The bank can still see your behavior. They know your payment history. They know your spending patterns. They know your credit utilization. They have plenty of data about you already. The one thing they don't have, if you don't give it to them, is a fresh, updated income number to feed into their targeting algorithms. As a dog, I can tell you that giving information to someone who's going to use it against you is not smart behavior. If I had to tell the vet my exact weight every time I went in for a checkup, they'd know I've been stealing extra treats. So I'm not volunteering that information. I'm keeping my weight between me and my bathroom scale. Let's go back to Sarah and Mike for a minute, because this is where the story gets really depressing for Sarah and really encouraging for Mike. Remember, Sarah's been paying about $1,700 per year in extra costs because she keeps updating her income. Mike's been paying zero extra costs because he doesn't. Year 5, Sarah has paid $8,500 in unnecessary fees and interest. Mike has paid $0. Difference, $8,500. If Sarah had invested that $8,500 at 10% returns instead of giving it to her bank, it would be worth $13,700 today. Year 10. Sarah has paid $17,000 in unnecessary fees and interest. Mike has paid $0. Difference, $17,000. Invested, that would be $27,100. Year 20. Sarah has paid $34,000. Mike has paid $0. Difference, $34,000. Invested, $97,400. Year 30. Sarah has paid $51,000. Mike has paid $0. Difference, $51,000. Invested, $277,000. Same income for 30 years. One person updated a field in an app. The other one didn't. The difference? $277,000 in wealth. But wait, there's more. As a dog, I know you have to look at the full picture. That $277,000 is just the money Sarah handed directly to the bank. What about all the purchases she made because of her higher credit limit? What about the lifestyle inflation that came from thinking she could afford more because the bank gave her access to more credit? Studies show that people with higher credit limits spend 10 to 15% more on average, even when controlling for income. Sarah's limit went from $8,000 to $15,000. Let's say she spent just 10% more because of that psychological permission. Her average monthly spending went from $2,000 to $2,200. That extra $200 per month over 30 years, if invested instead of spent, would be worth an additional $406,000. Total wealth difference between Sarah and Mike over 30 years, $683,000. Same income, different data strategy. Mike's not a financial genius. He's not doing anything complicated. He's just not volunteering information that would be used to separate him from his money. That's it. That's the whole strategy. Don't feed data to algorithms designed to extract maximum profit from you. Let that number sit for a second. $683,000. That's the lifetime cost of being a good customer who keeps your bank updated with fresh information they'll use against you. Okay, so what's the play here? What should you actually do? Step 1. Stop updating your income on existing accounts. Period. Next time that pop-up appears, close it. Don't feel guilty. Don't feel like you're doing something wrong. You're not lying. You're not committing fraud. You're just declining to volunteer information that isn't required. The pop-up will come back in 3 months. Close it again. It'll come back in 6 months. Close it again. Eventually, the algorithm will give up and leave you alone. Step 2. When applying for new credit, provide conservative income numbers. You're not lying, you're being conservative. If you have variable income, use your lowest earning months. If you have multiple income streams, you don't have to include all of them. Report accurately within these bounds, but don't volunteer more than necessary. If you earned $75,000 but had a bad year and only made $65,000, report $65,000. That's accurate. You're just choosing which time frame to use. Step 3. Opt out of marketing where possible. Most banks have opt-out options buried in account settings. Find them, use them. You want to get removed from targeted marketing lists as much as possible. Step 4. If you do want a credit limit increase, provide income only for that specific purpose. Sometimes a higher limit is actually useful. Maybe you have a large purchase coming up. Maybe you want to improve your credit utilization ratio. Fine. In that case, provide updated income to support the increase request. But only do this when you have a specific reason. Don't update just because they asked. Step 5. Ignore phone calls asking to verify your information. These are sales calls. Politely decline and hang up. Your account will not be closed. Your credit will not be damaged. The bank just won't get the data they wanted. Step 6. Let your behavior speak for itself. Pay on time. Keep utilization low. Maintain accounts for years. These behavioral signals are far more valuable than your stated income. Banks can see these directly. They can't manipulate your behavior as easily as they can manipulate your response to a targeted offer. If you pay on time for 5 years straight with $60,000 of reported income, you're a better customer than someone who pays late occasionally with $150,000 of reported income. The bank's algorithm knows this. Let your actions do the talking. Step 7. When you do provide income, understand you're trading privacy for something specific. Sometimes the trade is worth it. Applying for a mortgage, you're getting a house. That's worth the data exposure. Updating your income for no reason when a pop-up asks, you're getting nothing. That trade doesn't make sense. As a dog, my strategy is simple. I only give information when I'm getting something valuable in return. The vet asks my weight, I'll give it if I'm getting vaccinations that keep me healthy. Random dog at the park asks how many treats I have. I'm not answering that. There's no benefit to me. Humans should think the same way. Here's what this is really about and why it matters beyond just your bank account. Banks have enormous amounts of data about you. They know your spending patterns down to the day and time. They know which merchants you visit. They know your payment history over years. They know your credit utilization hour by hour. They use machine learning algorithms to analyze this data and extract maximum value from your relationship. Meanwhile, you know almost nothing about their internal processes. You don't see the algorithms. You don't understand the targeting. You don't know how your data influences your treatment. This asymmetry is by design. Banks invest billions in data infrastructure and algorithmic optimization. They hire PhDs in behavioral economics to design systems that maximize profits. They A/B test every pop-up, every email, every offer to find what works best at getting you to do what they want. You have none of that. You're one person with a phone, making decisions based on incomplete information and manipulative framing. Refusing to volunteer additional data doesn't level the playing field. The bank still has massive advantages, but it reduces the asymmetry slightly. It takes away one weapon they would otherwise use against you. And here's something important. This same principle applies far beyond banking. Every institution that asks for your data, tech companies, retailers, insurance companies, employers, is collecting it for their benefit, not yours. They frame requests as serving you better, improving your experience, ensuring accuracy. These framings obscure the real purpose, which is enabling more precise value extraction. Data minimization is a legitimate life strategy. Provide what's legally required. Provide what's necessary to get something you actually want. Decline everything else. Facebook asks for your phone number to secure your account. They actually wanted to build a more complete profile for advertisers. Decline. Retailers ask for your email at checkout to send your receipt. They actually want to add you to marketing lists. Decline. Your bank asks to update your income to serve you better. They actually want fresh data for their targeting algorithms. Decline. Once you see this pattern, you can't unsee it. Every data request is an extraction attempt dressed up as a service. As a dog, I find this hilarious. Humans built these incredibly complex systems to manipulate other humans, and then most humans just comply without thinking. If I built an elaborate system to trick other dogs into giving me their treats, I'd be the alpha of the whole neighborhood. But I don't need to, because I just take the treats when nobody's looking. Humans overthink everything. Sarah and Mike started in the exact same place. Same income, same bank, same opportunities. Sarah thought being a good customer meant keeping her bank informed. She updated her income every time they asked. She responded to offers. She took the credit limit increases. She said yes to premium products. 5 years later, she's paid $8,500 in completely avoidable fees and interest. 30 years from now, that decision will have cost her $277,000 in wealth she could have built. Mike made a different choice. He closed the pop-ups. He ignored the offers. He kept his simple setup and let his behavior speak for itself. 5 years later, he's paid 0 unnecessary fees. 30 years from now, he'll have $277,000 more wealth than Sarah, despite having the exact same income. The next time that pop-up appears on your screen, update your annual income to help us serve you better, you'll know exactly what it means. It means, give us fresh data so our algorithm can optimize profit extraction from your account. Close the pop-up. Keep your information to yourself. Let your responsible behavior be the only data they get from you. That's the play. That's how you win against algorithms designed to beat you. As a dog, I can tell you with absolute certainty, the squirrel who tells other squirrels where his nuts are buried is the squirrel who goes hungry in winter. Don't be that squirrel.